So return on capital employed as an appraisal method. Don't forget, by the way, you have to be careful that you have a ratio called return on capital employed, and you have an appraisal method called return on capital employed. So be careful that you don't make mistake to distinguish the two. Okay. So first, the return on capital employed as a financial ratio. Okay, we're trying to make an assessment. Okay, of how much return, how much profit, okay, has the company made within a given time period based on the capital the company has invested, okay? As a ratio, let me just go through it as a ratio. Okay, so as a ratio, okay, don't forget is given us return on capital employed as a financial ratio is given as the net income, okay, of the company that has achieved over that time period. We divide by total capital employed, okay, we divide by the capital employed, okay, of course we express this as a percent, okay. This generally is the financial ratio, okay, trying to determine how much profit has the company capital invested made within a given time period, okay. But however, we are not discussing this, okay. We are discussing return on capital employed, okay, as an appraisal method, okay. So that was just to so that you don't make confusion, you don't confuse, okay. Now the return on capital employed as an appraisal method, okay. So here, actually just like they have mentioned under the financial, the return on capital employed as a financial issue, where when it comes to appraisal, okay, the return on capital employed is simply how much profit has a company made on that particular project for every dollar they spent on it, okay? How much profit has a company been able to make on the investment, okay, on that particular investment over its life, okay, for every dollar of initial investment the company did pay, okay? So generally, we do use what's called the average basis method. Okay, we use the average basis method. Okay, where we do determine between the time that you invest between year 0 and year n, what is the total profit you've earned? Okay, because you may have cases where the profit will be fluctuating. Okay, between year and year, between year 2, year 3, all the way to the nth year. So we get, therefore, we get the average profit. Okay, we get the average profit over the life of this investment, how much profit on average basis is this investment making for the company every year, okay? Then we determine what we call the average investment, okay? We determine what we call the average investment. And the average investment, okay, is given us the initial cost, we add the disposal value, we get our average, we divide by 2, okay? So therefore, it's simply the average investment, initial cost, plus the scrap value, okay, plus the scrap value of the assets, okay, we divide by 2, okay, that's therefore the average investment, okay, the average investment, where this is the initial investment cost, okay. Therefore, once you have the average investment and you have the average profit, therefore you get the return on capital employed to be equal to the average profit, okay, average profit you have obtained from a calculation, divide by average investment, and we express as a percent, okay, we express this as a percent. And that therefore is going to give therefore the return on capital employed, also referred to as the accounting rate of return, ARR, okay. Now the question remains therefore is that how do we make a decision as to whether we should invest or not invest in the project, okay? More often than not, the management will come up with what we call a target return on capital employed, okay? So the company management can say that we are only going to be investing in projects where the return on capital employed we shall be earning should be at least be, let's say, 30%. Okay, so any project below that target is rejected. Okay, any project above the target is accepted. Okay, that's how we make the decision as to whether we ought to invest in a project or not. You shall be comparing what is the project return on capital employed versus what is the target return on the management target return on capital employed. Okay, if the return on capital employed, if the ARR, the accounting rate of return is below the target, then of course we reject. Okay, if it is above, then of course we accept that particular project. Okay, and that's on the ARR, the return on capital employed. Don't forget, you're using accounting profit. You're using accounting profit. Okay, don't forget, you're using accounting profit. Okay. Now I have a question here, which I think I would want you to attempt first. Okay. We are meant to get the ARR, okay, of this project, okay, and of course, actually you can make a decision. So if the ARR, let me just put a note here, target ARR, target return on capital employed is equal to 25%, okay. So I want to make a decision based on the target, okay, should the company invest in the project or not? Don't forget, the return on capital employed is average profit divided by average investment. You can take 2 minutes. Attempt it first. Let me see if I can go. Make the attempt first. So we told that the profit to be earned by the company from year 1 to year 7 as follows: that the profit before depreciation and of course tax. Okay, what is the total profit before depreciation from year 1 to year 7?
1,750,000.
Okay, so fair enough. Let me open my work area. Okay, it is. So I can have here total profit before depreciation and tax, and we get 1,750,000. Then you can less depreciation. What is the loss of value of the asset? Which of course we call depreciation. What price do you buy the asset at? At what price do you buy the asset at?
800,000.
Okay. At what price do you dispose it for?
100,000.
Therefore, what's the loss of value of the asset?
700,000.
700,000. So therefore, we get the depreciation to be equal to 7,000. Therefore, profit before tax is equal to 1050. Do you pay tax?
Yes, at 30%.
Therefore, we pay tax at that percent. Then how much tax do you pay therefore?
Excuse me.
Yes.
How have you gotten the 700?
Okay, the depreciation is equal to, okay, it's given us the cost of the assets minus the scrap value, the disposal value. The asset was, you bought at 800,000, you sell it, or its just disposal value is 100,000. Therefore, its depreciation over those 7 years is 700,000. It's clear?
Yes, clear.
Okay. Tax, you pay how much?
30%.
Yes, of 1050.
315,000.
315,000. Okay. Therefore, you have profit after tax to be equal to 6 something. I don't know. 6. I don't know. Maybe 7. 705.
Yes.
705,000. Therefore, average profit to be earned. Therefore, it's total profit. 705,000. We divide by the number of years, which is 7, and you get 1.
Or 5.
You get 1 of 5,000. Okay. Therefore, they need to get average investment. Average investment, which is equal to the initial investment cost, which is equal to initial cost of the asset, plus the scrap value. We divide by 2. Cost was 800,000, plus the disposal value 100,000. We divide by 2, and we get 450,000. Therefore, account rate of return, ARR, average profit, which is equal to 105,000, average investment, which is equal to 450,000, and of course we express as a percent. 23 point.
23.3.
and the rate of
What?
percent. We get 3.3% to be the accounting rate of return. Okay. There was a mistake. Where are you making the mistake, guys?
We were forgetting about the depreciation.
No, you can't forget because it's accounting profit. You have to less depreciation.
Yes. I see it now.
Okay. Yes, and
Let
that's
us copy.
okay. Fair enough. Okay, time value of money. Okay, this is a topic, short topic, to assist us to be able to understand the discounted cash flow techniques. Okay, so time value of money, or simply the discounting time value of money. Now, time value of money. Generally, we normally say that for conventional investors, okay, in case you are a rational investor, and of course that's what we assume in capital market, is that the investor are assumed to be rational. And of course, in case you are to be given two options or two alternatives where you would receive a sum of money today, 1,000, for example, 1,000 cash in today, or a promise that in a year's time you will be getting that 1,000. Of course, the investor will be choosing the alternative where they get the money a bit earlier, okay, sooner than later, okay, because of all the time preference of money, okay. And why do we say that money has time preference? Because a number of things, okay. The person who is going to receive the money today, because he can be able to, first of all, be able to exercise the purchasing power of money, okay. You can be able to spend the money, okay. But the mere fact you have the power to be able to spend, okay, in itself is an advantage, okay. So, because that's we have one of the key factors that causes time preference for money is that the person to receive earlier is given that power, the purchasing power of money. And of course, you also have the alternative of being able to make the investment, okay. The person going to receive the money a bit earlier can be able to invest money and also earn interest on top of the money received. Okay, because of all these factors, we normally say that money received earlier than later have a higher value. Okay, compared to the later sum of money to be received. Okay, that's what we call the time value of money. Okay, just write that down. Okay. But assuming that investors are rational, maybe just a very short note here. Investors are assumed to be rational. Of course, these are the capital market theory. Investors should be rational, and they prefer to receive money earlier than later. Okay, that they prefer to receive money earlier than later. This could be explained. This could be explained by the time preference of money, by the time preference of money. I hope my handwriting is not too bad. If it is, let me know. Yeah, this could be explained by the time preference of money. Okay, and why is that the case? Okay. One, of course, is that the investor, the reason for the time preference for money is that the investor is granted the purchasing power, is granted the purchasing power of money, is granted the purchasing power of money earlier of course, than later. Okay, because the factor is that the investor who receives money earlier can choose to invest, and earn interest on the sum of money, So of course, this is therefore called concept of that there's a time preference for money, time value of money. Okay. That having said, therefore, the time preference for money, therefore, investor, the sum of money received earlier has a greater value than the same sum of money received later. What we call here time value of money. That the investor is going to see a bit earlier. Whoever is going to see the money a bit earlier, therefore, will have a higher value, okay, compared to the person who is going to be receiving the money later on. Okay, so there's the investor, therefore, do attach higher value for money received earlier than later on. Okay. Hope it's clear. Let's do an example. Okay, there are two concepts which I think I don't want to discuss. There are two concepts that we need to learn when it comes to time value of money. One is called compounding, and the other is called discounting. Okay, there are two concepts which we need to learn. So we can begin by discussing compounding. Okay, so the first concept we may want to learn is on compounding. Okay, compounding. Now, compounding is determination of future value of money. That's simply called compounding. Okay, this is the determination. This is the determination of future value. Future value of money. Okay, simple as that. So called compounding, the determination of the future value of money. For example, you can begin by discussing here an example. Mr. A invest 1,000 shilling in a bank account, that pays, that pay 10% interest per annum. What would be the amount in the account, at the end of 3 years from now, 3 years from today, 3 years from today. Okay, so I want us to make an assumption. Assume, so what is going to be? So let me qualify this statement here. Mr. A invests 1,000 shilling So let me just clarify here. Year end. Okay, so I've qualified here. So for those here, okay. So Mr. A invests $1,000 at the year end, or the year end, in a bank account that pays 10% interest per annum. What will be the amount in the account 3 years from today? Okay. Don't forget the investment is being done at the end of the year. Okay, the investment is being done at the end of the year. Okay, therefore, you can say that the investment value. Okay, don't forget you invest in the end of the year. So you can call this year or this period. Because the best term is to use period actually. So we call it year. Okay, solution sort of. So we can call this period. Period 1, period 2. Okay, period 3. Then you can say interest and yeah, let me just call it interest and interest we earned. Don't forget you're going to be investing the 1,000 at the end of year 1. Okay, it is at the end of year 1. Therefore, the interest you'll be earning, okay, is going to be for year 2 and for year 3. Because you invest at the end of year 1, so the interest is going to be earned year 2 and year 3. Okay, so year 2 and year 3. Okay, therefore, in year 1, in quotes, you don't earn for this year. You won't earn any interest because you're not investing today. You're investing end of the year. So this particular year, you don't more or less earn. Okay, you just remove this 1 year. Okay. Therefore, in year 2, that is next year, you earn interest, which will be 10% of the amount you did invest. So 10% of the 1,000 you have invested to give a therefore 100. Therefore, next year you earn 100. Okay. Then assume that you don't withdraw the money. Okay, you don't withdraw the interest you've earned. Therefore, you can see therefore at the end of year 2 next year, the total amount you have in the account is the 1,000 plus the interest you earned, which give therefore 1,100. Okay, then that's also an interest, which we earn interest in year 2 to give therefore 110. Okay, to give therefore 110. Therefore, the total interest you've earned over the life over those from today until the end of year 3 will be equal to 210. Okay, therefore the total amount earned is equal to 210. Okay, equal to 210. Therefore, the total investment you have end of year 3. Okay, total investment you have end of year 3. Let's say, let me just put here now here. Therefore, the value of the account end of year 3 will be equal to a value investment is the 1,000 that you spent plus 210. Okay, to give therefore total investment you have. Total investment you have will be equal to 1,210 shillings. Okay, look at this, a simple discounting. Okay, here determining what is going to be the value, okay, of the bank account 3 years from now. Okay, determining the future value is a simple compounding. Determining the future value is a simple compounding concept. Okay, clear?
Yeah.
Now, assume that we may be having a case.
Question.
Yeah, question.
Yeah, on the when we are calculating the solution on the interest part, so we assume like on period 1 we have year 1, year 2, year 3. So the end of year 1, it's what we are having at 1,000, right?
Yeah, year 1 you have 1,000. Yes.
So now at the end of year 2, that's when now it will incur an interest of 10%. Okay, thank you.
Okay. Now let's make a simple twist, okay, to the question and assume that the interest to be earned is going to be whatever you start investing today, not at the end of the year, okay, but you start investing today, okay. Therefore, if that's going to happen, okay, the same example, I'll just remove this bit here, okay, and replace it that the investment is occurring today. You are investing this 1,000 today, okay. Therefore, it will be equal to this example 2. Okay, assume the $1,000 investment, 1,000 share investment, okay, is invested today. So you don't have to wait until the end of the year. Okay, therefore, okay, we can replicate the same thing like this table you have had done here. Okay, where now this year you also earn interest. Okay, so this year you also be earning interest. Okay, so period. So the facts remain as they were before. Okay, year 1, year 2, year 3, and say the interest you'll be earning. Year 1 you earn 10% of the amount you have just invested today. Okay, 1,000 to give us 100. At the end of year 1, you have 1,000 that which you have already invested plus the interest you earn, 1,100 times 10%, give therefore 110. Okay. Then at the end of year 2, well, that is end of next year, the total amount the company is having in the account, 1,000 plus the interest earned in year 1 and year 2. Okay, to give therefore 1 to 10 times 10%, give therefore 121. Therefore, total interest to be earning for those 3 years, okay, will be equal to 331 to give 331. Therefore, we can say the investment value, okay, end of year 3, okay, we add the initial investment 1,000, give therefore 1,331. Same with that. And actually, what if you have 20 years? Okay, and of course, if you have an investment for a period of 20 years, and of course, this might be a lot of work. Okay, so the best thing you can compound. Okay, you can say that future value. Say that sorry. You can say that future value is given us the current amount you have invested. Let me just call it present value. You invested today. Okay, present value 1 plus the compounding rate to the power of n. Okay, where can call where FV is the future value. PV is the amount, we just call it present value. The present value of the amount which we are investing. R is the compounding rate, the compounding rate for the period. And N is the number of periods. They can be years, they can be months, can be weeks. For our context, the periods are in years. Okay, number of periods. So you want to get the value at the end of year 3. Okay, so this will be equal to future value. Present value, we have invested 1,000. Okay, the return you're earning is 10%, 0.1 for 3 years. Therefore, how much do you get to be the future value?
You get the same 1,331.
And so you get therefore 1,300, and that one to be the future value at the end of year 3. Okay, if you invest 1,000 and every year you earn an interest of 10%. Okay, so this becomes easy in case you have 20 years. You don't have to do every year individually. You just simply apply the formula. Okay, clear?
Yes.
Okay, question? Okay, so no question. Now, what if, let's even make the question a bit in quotes tough. What if now this person decide to invest every year 1,000? Okay, so they don't just invest 1,000 and wait for 3 years, but every year, beginning of the year, they make the investment of 1,000. Okay, so you want to determine what will be the value of the investment at the end of year 3 if every beginning of the year they do invest 1,000. Okay, let's show that example. Okay, so we can call this example maybe 3. Assume the investor. Assume the investor invest 1,000 shilling beginning of every year for 3 years. Okay, what is the future value? End of year 3. Okay, so this is an example, okay, that now you are investing every year, okay? You don't just invest today, but every year you'll be investing 1,000 for those 3 years, okay? So you can extend, you say year, which is the period. In year one, you invest 1,000. So year one, you invest 1,000 and you earn 10%. Therefore, year one, you earn $100, 100 shillings, okay? In year two, don't forget you already have the 1,000 you did invest in year one, plus what we invested today, year two, okay? Therefore, the total initial investment is 2,000 plus the interest you have just earned, which in this case is equal to 100. Therefore, 2,000 plus 100 to give us 2,100 times 10%. Okay, just repeat. At the beginning of year two, you have the 1,000 you had, which you had in year one, plus the 1,000 you are investing to give us 2,000, plus the interest you earned in year one to give us 2,100. This again give us 210 to give us 210. Then in year three, same thing. You are on top of what you already invested, you earn another 100. Therefore, the total investment you have beginning of year three is 3,000 plus the interest earned so far, 100 plus 210. Therefore 3,310, I guess.
Yes.
Times 10% to give us 331. Therefore, total interest you earn over those 3 years, okay, is how much? 6 what? I don't know. 6.2. I don't know. 41.
641. 641.
641. You earn 641 the total interest you earn over those 3 years. Don't forget your investment, okay, is equal to 3,000, isn't it?
Yes.
Okay, they have plus 3,000 to give, therefore, total investment value to be equal to that 641 shillings. Okay. Clear? What if you have 20 years? Are you going to do all this work? Okay, it's going to be out of work for you. So you can use a formula, okay, where you can see that the future value is given as the present value. Let me so since every year you're investing 1,000, every year you are investing 1,000, then that's 1,000, since it's an equal amount invested over an equal time period, we refer to it as annuity, okay, annuity, okay. So therefore, let me just call it as annuity, okay, given 1 plus r, the power of negative n minus 1, we divide by r. So let me just extend this bracket here. Okay, there's a formula you can use, okay, in case you want compound an annuity, okay. So applying the formula, R is the discount rate, N is the number of years. Okay, annuity is 1,000. The equal cash flow you are investing every time period be equal to 1,000 times 1.1, the power of negative 3, minus 1, divided by R, which is 10%, 0.1. Give us how much? This should be power of 3. Sorry, this should not be negative n. This should not be a negative. Sorry here.
Yes. Yes.
That should not be a negative. You get how much?
Mm-hmm.
It's giving a different
3,310. 3,310.
3,310.
Yes.
Yes.
3,310. Okay. Can you multiply this by 1.1? To multiply this by 1.1?
$36.41.
That's 641. That's 41. Yeah, we need to qualify. Now the concept which you want us to introduce it. Now, since you are investing beginning of the year, then when it comes to application of the formula, you need to take that note in your analysis. Okay, that say the cash flow are not occurring at they're not occurring in arrears, but they're occurring at the beginning of the time period. Okay, I'll fast forward the concept, but anyway, then you need to qualify our factor here. Okay, this is called the present value. This is called the present value annuity factor. Okay, by multiply by 1 plus R. Okay, I've just fast forwarded to for you times 1.1. Okay, I think that's where you're getting a different answer altogether. You get a 641.
Yes.
That's 641. Okay. Yeah, you have to be quite careful when it comes to the time value of money. Okay, if the cash flow is going to be at the beginning of the year, okay, like in this example we have just done here, okay, then you have to qualify your formula here, okay, by adding 1 plus R here, by adding 1 plus R there, okay. If the cash flows are occurring at the end of the year, for example, in case you've not been told that they are occurring at the beginning of the year, that is, they are occurring, sometimes the term used is they occur in arrears, then of course you don't need to add this factor here, the one we just added here. We don't need to add this factor here in our formula, 1 plus R. But if the cash flows are occurring at the beginning of the year, then of course we need to adjust, okay, because you'll be having a cash flow earning 3 interest, okay. We'll be having a cash flow that earns 3 interest. That's why we need to add the 1 plus R. Okay, so if in this example, the cash flows are occurring, you are investing end of the year, then what will be the difference here is that you don't forget in year 1 you don't earn any interest. Okay, in year 1 you don't earn any interest. Okay, year 1 there is no interest to be earned if you are investing end of the year. Okay, that will be equal to year 0 you earn nothing. Year 1 you earn nothing because you are investing end of year 1. Okay, in year 2 you'll be having 1,000. You'll actually be having 1,000. Yes, so you'll be having 1,000 because you are investing end of year 1. Beginning of year 2, you have 1,000. You have just taken. You have just invested in the previous day, the end of year 1. Okay. Therefore, you'll be having 1,000 here, and 10% for you to give us 100. In year 3, okay. In year 3, okay. Well, at the end of year 2, you have now 1,000, which already have you did invest end of year 1, okay, plus what you are investing beginning of year 3, end of year 2, plus the 100 you have. Is that clear?
I have a question.
Mm-hmm.
You said now, okay, I understood, like year 1, when you're investing at the end of the year, you've invested 1,000, so you're not going to get an interest, right? And then coming to year 2, now when investing at the end of the year, I thought it's supposed to be the amount because you're investing 1,000 yearly, right?
Every year, end of the year.
Yeah, so I think the 1,000 you invested on year 1 and 1,000 you invested on the second year, the end of second year, and then you multiply by 10. Okay, that is what I'm thinking. So the only the only difference is on year 1 because where we'll have 0, but on year 2 we have 2 investments now.
Yeah, I agree, but that interest, the 1,000 you did invest in year 1 and the 1,000 you have invested in year 2 earn interest for you in year 3, not year 2, isn't it? Because you are investing end of the year, isn't it?
Oh yeah, I get.
Yes, you are investing end of the year, not beginning, not like in this example. Sorry.
Oh, okay. So the 1,000 that you are having like at the year 2 is the one that you had at year 1. So it's the one that has earned now interest at the end of the year.
True.
Okay, I get it now.
So in year 3, the interest to be earning is the 1,000 you invest year 1, the 1,000 you invest in year 2, plus the interest earned in year 2 also. Okay, to give therefore 2,000 plus the 100, the 2,100 here, times 10% to give us therefore 210. Hope that's clear. Don't forget the amount you will be investing ahead of year 3 don't earn any interest because you're in year 3 already. Okay, so you don't earn any interest. Therefore, the total interest to be earning will be equal to 310 plus the 3,000 which you've already invested over those 3 years. Give therefore the 310. Okay. So be careful with when is the timing. Is it occurring end of the year or beginning of the year? Okay. If it's occurring beginning of the year, then of course you qualify our formula here. Okay, by adding 1 plus R. If it's occurring the end of the year, then of course you just use as it is. Okay, the 310 we have here. Clear?
Clear.
Okay, that's great. What else on time value money on compounding? Okay, let's compound. Okay, and assume. So this was example what? Example 3, example 4. Okay, let's extend to another example, example 4. And be very careful. If you don't understand time value money, then of course you have a very tough life in finance. So if something not clear, ask. Okay, because most of the concepts you'll be learning in finance, they will go back to time value money. Okay, so I hope it's clear. Okay, it's not tested that often. Okay, but of course the application bit of it is what will determine your life in finance. Dickens.
Yes, my question is, we have two figures here.
2 figures.
3,310, and the other one.
That's a 6 for fun, yes.
Yeah. So which one answers the question? The example 3.
No, the example 3. It's this. The answer. This is our. This is just by the way. And let me just. This one just by the way. We have just analyzed. This would answer in example 3. So this analysis here was what if the cash was occurring end of the year. This was end of the year. And this is what I wanted, but I confused in the example. This is what I wanted us to do first, because this one you need to add on what you already know. But either way, this is how you get the future value of cash invested end of the year. But the question was asking us to get beginning of the year. You see the difference?
Yes.
Yeah. So this is what we are meant to answer. This is what we have. What you have answered, the part in black here.
Okay.
It's clear.
Okay. So the part in black is the future.
Yes, but the part in black is what we are answering the question. But the part in red is what if the cash was to be occurring at the end of the year.
Okay. Thank you.
Okay. So example 4. Okay. What if now the interest you are earning is occurring every 6 months? The 10% is per annum, but you earn interest every 6 months. Okay. Assume the interest is earned half yearly. Okay. Maybe you want to say quarterly. It's earned every quarterly. Or if they assume that the interest is earned on a quarterly basis. So you earn the interest every quarter, okay? So you don't have to wait until the end of the year for you to earn the interest. And let's extend this example, okay? We assume that the cash flows are occurring to the beginning of the year. The same example we have done here, okay? They are occurring at the beginning of the year, okay? So we want to extend this example. However, the only difference is that now you earn the interest on a quarterly basis. Do you get it? You don't have to wait until the end of the year to earn the interest, but the interest you'll be earning is earned every quarter. What should be the future value? Do that first. Let me see how far I can go. Is it clear? No, it's clear. If you not ask. Okay, seems it's clear.
The one we're computing is on from the beginning or at the end of the year?
No, at the beginning of the year. That's the same example. Beginning of the year. Beginning of the year. Beginning of the beginning of the year. So is example 3 extending to example 4? Okay, the determination of the present value of the sum of money is so the fact was the discounting. Okay, discounting. Okay. Yeah, let's kind of begin by doing an example. Example. An investment. We're going to extend the same example. An investment yields 1,000 shilling at the end of year 3. If the discounting rate is 10% per annum, what is its current value? Its current value. Okay, so you have an investment that yields 1,000 shillings at the end of year 3. So if the discount rate is 10% per annum, we want to get what's the current value of this sum of money, okay, of this 1,000, which you'll be getting in year 3. Don't forget, you only get it once, okay, you only get it once. Now recall, okay, recall that we have said that the future value is given as present value, okay, 1 plus r to the power of n. But now we want to get the present value because we want to get current value. Therefore, present value is equal to future value, okay, 1 plus r to the power of n. Okay, if you can say, therefore, the present value of this 1,000 is 1,000, which is a future value because it's a value at the end of year 3, okay, times 1 divided by r is 10%, 1.1, the power of 3, and you get 756. I don't know. What do you get? 756?
$751.
751.
Yes.
I guess 751. So yes, 751 to be the current value of this 1,000, okay, which will be received at the end of year 3. Okay, quite straightforward. Now let's extend. We do another example. Let us give you that example to be example 1. We do example 2. Example 2. Same investment. Same an investment yields 1,000 shilling every year for 3 years. Every year for 3 years. Determine the current value, determine the present value, determine the present value of the investment, if R, the discount rate, is 10% per annum. So you have here an investment that yields 1,000, okay, every year. Okay, it is yielding 1,000 every year. So you want to get the present value. You want to get the present value of the amount we received from this investment. Okay. So we can have year 1, year 2, year 3, and then here I can have the cash flow you're earning, and I can get here present value interest factor, which is 1 divided by R. I can get here present value. The cash flow every year you earn 1,000, so every year is 1,000, 1,000, and 1,000. We discount back to year 0, okay? Because the factor here is 1 divided by 1.1. Don't forget, you want to discount from year 1 to year 0. That is today, okay? The power of 1, okay? And you get 9909, okay? Then this is year 2. We are discounting from year 2 to year 0, so 2 years later, okay? So 1.1 squared is a factor to give us 8 to 6, not sure about the figures, confirm. Year 3, we are discounting from year 3 to year 0, so 3 years. So 1 divided by 1.1 to the power of 3, they give us 751. So to give us 24.
2487.
2487. Therefore, the present value of the 3,000s in quote you are receiving for every year for the next 3 years. Clear? Now, what if you have 20 years?
On my
Mm-hmm.
end, I haven't understood how we've gotten the PVIF.
Oh, the PVIF is simple. This is called the present value factor. This is what we call the present value and factor. This formula. 1 divided by 1 by R. So
okay, I was trying to check on the formula we've indicated. The PV is equal to the future value of up there, not this scroll upwards.
yeah.
Yes, I was trying to derive this particular formula. So here, like, how is it 1,000 times 1 divided by 1.1 and
Oh, okay. Now the present value.
I think I'm a little bit confused somewhere.
The present value is the product, is the cash flow times the factor to give us 909. So 1,000 times the factor, 826. The 1,000 you're getting times the factor to give us 751. Okay, I'm not sure that, but I hope that's what you mean. But
Excuse me, sir. If they're investing every year, and shouldn't year 1 have no investment interest?
no, you not invest. What's happening? The investment is giving back money. That every year, this investment is giving you as the investor 1,000 every year. So 1,000 is like the interest you're earning. So here we have an asset, we have an investment that is gives back to the investor 1,000 every year for the next 3 years. So we are discounting that 1,000 back to year 0. And was that your question? Have I answered? It's good to be clear.
Yes.
Okay. Now, in case, of course, there are like 20 years, you can't do this table. Of course, you need to use a formula. Okay. Don't forget, this 1,000 is a constant amount you are receiving every year. Okay, and the time difference you are receiving is 1 year. Therefore, you can not assume, this 1,000 is therefore an annuity. Okay, therefore, you can say that the present value of the annuity will be equal to the annuity, this 1,000, okay, 1 minus 1 plus R to the power of negative n divided by R. Okay, therefore it will be equal to 1000 times 1 minus 1.1 negative 3 for the 3 years. We divide by 0.1. What do you get?
$24.87.
You get 24.87. 24.87 becomes for the present value. Okay, so it's much easier to use a formula in case you have a lot of annuities that you want to discount. Okay, so it's much easier to use that formula. Clear? Okay, I think we can extend that is discount in annuity. If we discount, okay, discounting here where you get the earnings are received more frequently. Example 3, assume the investment yields $1,000 every half year. The discount rate is 10% per annum. Determine present value of the investment with the present value of the investment yield 1,000 half yearly for 3 years. Let me here qualify here for 3 years. For 3 years. For 3 years. Tell the present value of the investment. Yes. What do you get? Okay, from Sharon, to get 53, that's 3. Let's see. Since this cash flow is being received at the beginning of the year, of course, we need to qualify our formula there by adding 1 plus R. That's all we need to do, adding 1 plus R. Therefore, the present value will be 1,000. Okay, 1 minus 1.05 to the power of -6, divided by 0.05. But this cash flow is at the beginning of the year. Therefore, 1 plus R, 0.05. Okay, and we get how much? You guess?
5330.
5330. Okay, 5330, 5333, not too different. Okay, and that's will get the present value in case the cash flows are received or paid for in advance or at the beginning. Okay, actually, the other term that is normally used to refer to cash flows paid in at the beginning, okay, is what we refer to as cash flow being received in advance. The term advance means beginning of the year. Arrears mean end of the year. Okay, so maybe those are two terms you may want to keep note of. Okay, advance or in arrears. Any other example remaining? Let me see. Okay, they can do another example here. What if the investment? What if the investment yields other shillings end of the year, year end, in arrears, let me call them in arrears, per annum, to infinity, what would be the present value? What would be the present value of the investment? What would be the present value of the investment if R is equal to 10%? So this investment yields 1,000 per year, every year, okay, to the foreseeable future, to infinity, okay. So there's no end period when this is going to happen. If that's the case, therefore, we normally say that the present value of such an investment is the amount to be earning per year, the equal amount to be earning annuity, okay, referred to as sometimes as the perpetuity. It's referred to as the perpetuity. We divide by R, simple as that. If the present value of the investment is 1,000, we divide by R, which is 0.1, to give therefore 10,000 shillings to be the present value of all the 1,000 that this investment shall be yielding to the foreseeable future. Okay, simple as that. Actually, the other term that is used to refer to cash flow that is paying to infinity is the foreseeable future. Okay, so maybe it could be good to note it. Infinity, sometime in your exam you might fail this term, okay? It earns to the foreseeable future. Foreseeable future, okay, that means to infinity, okay? Foreseeable future or to infinity. So something else, medium time value. Yes, I think there's another example we can do on what we refer to as delayed annuity, okay? Okay. Another example we can do assuming the investment yields 1,000 shillings per annum starting 3 years from today. Assuming the investment yields $1,000 per annum starting 3 years from today for 3 years. R is equal to 10%. Determine the present value of the investment. And by the way, in case the question is silent, it doesn't tell whether cash flows is in advance or it's in arrears, and of course we assume the cash flow is in arrears. It is occurring at the end of the year. So what do you get? First work it out. Let me see how far you can go. One dozen. That's right, 1867.
Yes.
Okay, let's work it out together. Now you know that this investment is going to yield 1,000 every year for 3 years, but starting 3 years from now. So because therefore you get the money in year 3, you get the money in year 4, and you get the money in year 5. Okay, every year 1,000, 1,000, and 1,000. Of course, discount back to year 0, discount back to year 0, and discount back to year 0. Okay, so we can do it individually. Okay, so the year 3, let me just call it the year 3 to be the year 3 cash flow. Okay, is 1,000, discount back to year 0. Now, actually, let me show you how to use the tables, because you have the tables with you in the past papers. Okay, so we want to discount 10%, but year 3. So if I was to get the, give me a second, I get the past paper which I shared with you. Okay. Okay, so the past papers which I think I shared with you, and at the end of any past paper, you will see such tables. Okay, so the examiner do give you these tables. Okay, so there are 2 tables. The first table is in case you want to discount the individual cash flow. The second table is in case you want to discount an annuity. As you can see, it's written here, annuity. So you should not make that confusion between which table to use. This is in case you want to discount annuity, and the first table is in case you want to discount single cash flow. Okay. For my example here, I want to use single cash flow. So therefore, I'll be using the first table. Okay. And I want to discount the cash flow, the cash was occurred in year 3. Okay. But at 10%. Okay. So 3, 10%, this 10%, and this is 3. Okay. Where the 2 coincide, that's a factor, which in this case is equal to 7513. Okay. 7513. So therefore, I can discount. My tables working here. So 1,000 times 7513. Okay, that's year 3 cash flow. Year 4 cash flow to get the present value is 1,000. Discount by the factor for year 4, 10%. So year 4, 10%. Going back to the table. Year 4, 10%. I get 6830. So the cash flow times the factor. Okay, so you share 6830. Then year 5 cash flow, year 1,000 time year 5, 10%. I want to discount year 5, 10%. So new share back to the table. Year 5, 10%, and I get 6209. So 0.629. Let's give us 731, 683, and 629. Sum total.
$20.63.
2063. You get 2063 to be the present value. Okay. Of course, in case you have a lot of cash flow, that is going to be quite the best thing to do. So you can use also the formulas, okay, or the tables. The best way you can do is that you consider that you don't get this cash flow in year 1 and year 2. Year 1 and year 2, there's no cash flow you're getting. So you're getting 0. So here is nothing, here is nothing. But we can assume, what if we were to get the cash flow for the 5 years? Okay, that is year 1, year 2, year 3, year 4, year 5. Is an assumption you're making. Okay, the present value of that cash flow would be, okay, the present value would be equal to 1,000 times the factor. Okay, so let me go back to the tables and show you how to use the tables again. But now I want to discount as an annuity. Okay, I want to discount that as an annuity. So use therefore the second table. Okay. I'll use second table where they have annuity. So 10%, 5 years, okay, 10%, you have it here, 5 years, where the two intersect, 3.7908, okay. So I want to discount as an annuity, okay, assuming that I get this 1,000 for the entire 5 years, okay. So therefore, be 1,000 times the factor, 3.7, that's 3.7908. Okay, so 3.7908. Okay. However, the reality is that you don't get the money for the first 2 years. Okay, for the first 2 years, you don't get the money. So therefore, remove the factor for the first 2 years because you don't get it. Okay, going back to the tables, the factor for the first 2 years, okay, is equal to 1.7355. So we remove that factor because you don't get the money for the first 2 years. Okay. So 1 point, what's happening here? So 1.755355. It's a minute, what's happening? Where should I be? Yeah. Okay, 1.7. I've even forgotten. 1.78, I guess. 1.3, what's that? 7355. 7355. Can you get how much?
$20.55.
You get 20.55. Okay, we get 20.55 to be the present value. So it's given us almost the same answer. I'm not sure there's the difference of 5, but anyway, you get 20.55 to be the present value.
Excuse me, sir.
Sure.
Kindly repeat the concept for the second part, like on the annuity.
Okay.
Yeah, like
So
why we. So here it's like you said we have we assume that we are investing for 5 years.
Yeah, we are getting the return. We are getting the return for 5 years. So okay, sorry, ask.
Okay, I'm saying like now the 3.79 we checked on the year 5, right?
Yes, we did. We assumed that you're going to be getting 1,000 every year. Okay, this is from the formula. This is from the formula 1 minus 1 plus r to the power of negative n minus r. Don't forget, this is where you got it from. So we assumed, what if you have to get this 1,000 for the entire 5 years? Okay, every year you get 1,000 for the next 5 years. Okay, it'll be equal to 1 minus 1.1 the power of negative 5 0.1. Okay, I think you get something similar. Okay. However, the reality is that you don't get the money for those for the first 2 years. You don't get it, isn't it?
For the
first 2 years.
Why are we assuming the first 2 years you're not getting it?
Because you're not getting, that's the reality. Because it's starting 3 years from today. So for the first 2 years, yeah, for the first 2 years, you don't get the money.
Oh yeah, I get it now.
Yes, so therefore, now we remove for the first 2 years because you're not getting the money. So we remove the factor for the first 2 years. So 1 minus 1.1 to the power of negative 2, 0.1. Then we multiply by the 1,000. Okay.
Oh yeah, I get it now. Thank you.
Yeah. Okay. I'm sure there's something else, another concept we need to learn. Delayed cash flows, we have learned that. Cash flow in advance, we have learned that. Multiple cash flow paid during a period, we have done that. Okay, and I think for now, I think that's more than enough. Okay, don't forget to buy the just to remind you, in case you don't get tight in time value money, then you have a very rough time in finance. And finance is quite easy, by the way. Okay, anyway, so that's on the time value of money. So maybe the next time we meet, we maybe do some few questions from your examiner on how to apply those methods, okay, to apply the discounting concepts and even compounding concepts in some questions your examiner has asked in the past, and of course we apply it to the discounted cash flow techniques, okay, the NPV, the IRR, as well as the discounted payback period, okay. Don't forget, the idea here was to get to know how to discount, then apply the discounting, okay, towards an example, okay. Question?
Yes, I have a question.
Ask.
It's on what Kendi was asking. I didn't get how where we are told that the 2 years you're getting 0.
Okay, so I'm going back to the example. Assuming the investment yields 1,000 per year, starting 3 years from today. Starting 3 years from today. What does that mean?
It means 3 years from today.
Yeah, that's what it means. Therefore, for the first 2 years, you don't get the money. That's what it means. Starting 3 years from today. For the first 2 years, then don't get the money, because the 1,000 is going to be received 3 years from now.
Okay.
Is that clear?
Yes.
Okay. Then you get the money for 3 years. Okay, therefore you get the money for 3 years, year 3, year 4, and year 5.
Can you scroll down to the previous example you did?
Previous example. This one.
Yes, the one. Okay. So, okay, I think I didn't understand this place where in arrears, like, what is the investment?
In arrears means you get the money at the end of the year. If you're getting the money, this 1,000 is to be received at the end of the year, not beginning of the year, but at the end of the year. That's what that means.
So, does it, like, if it's in arrears, does it get an interest?
Yes, you get interest. In year 1, you don't get the interest in year 1. You get the interest in year 2.
Oh.
Because you are earning this 1,000. Assume that you're not going to withdraw this money you're earning. Therefore, the interest to be earned in this 1,000 starts beginning of year 2. Sorry, year 1 it doesn't earn any interest for you.
And okay, what did you mean by the infinity? Like, I'm seeing infinity.
Infinity means that there's no end. There's no end to the investment. It is going to give you 1,000 every year, forever, in quotes.
Okay.
Yes, that's what it means.
All right. So it's not like the previous questions whereby we've been good maybe after 3 years. Or, yes. So this one it's in.
It is going to be earning this 1,000 every year with no end period. That's what it means.
Okay, thank you.
Okay. And I said that in some cases, the examiner wants to mention the infinity. So the conventional term the examiner is going to mention is the term foreseeable future. But that means infinity. Okay, it means in quote forever.
Okay, thank you.
Okay, any other question? Okay, enough. Then we can meet on Monday next week. We discuss on how to apply the time value of money, okay, to some examples, some questions asked by your examiner in the past, as well as apply it on the discounted cash flow techniques. Okay, so in case there's no other question, then I guess we can meet on Thursday. Enjoy the rest of the week.